Hello everyone, Jamie Trull here, your favorite CPA and financial literacy coach, and today we're going to be talking about year-end tax savings for small businesses. So how do we save taxes at the end of the year? Are there choices that we can make at that very end of the year in order to save money on taxes? So I'm releasing this towards the end of December. There's not a ton of days left, and so it's important to know and to really be thinking intentionally before we go head out on holiday and go enjoy some eggnog with our family, or at least before that ball drops on New Year's Eve. There are some things that you want to be thinking about that could save you money on taxes, okay? So let's talk about some of my tips related to those small business year-end tax savings. So the very first thing I want to talk about is the fact that timing matters, okay? Timing matters. So right now in my business, I've spent a lot of time thinking about, where do I want to have expenses? Where do I want to have income? Meaning, in which year? Okay, we're at the end of the year, so a one-day turnaround, whether something is charged on December 31st or collected on December 31st, could mean a very big difference between it being collected on January 1st of the next year. Okay, so this is one of those instances, especially because most small business owners are cash basis taxpayers. Now, I'm not going to go into specifically what that means right now, but if you are an accrual basis taxpayer, you probably know that, okay? You probably have accounts payable, accounts receivable, you have a balance sheet you're tracking all that information on, but most small business owners default to being cash basis, meaning on your profit and loss and on your taxes, therefore, you are recognizing expenses when you spend the money, right? When you charge it on the credit card, when you pay the cash out, that's when you're going to recognize that expense, right? That's the year. And for income, you're going to recognize it when it comes in. So even if you invoice someone, if they don't pay that invoice, if you invoice them on December 15th, but they don't pay that invoice until January 15th, then you as the business owner recognize that income in January when it comes in if you're cash basis. It's the opposite if you're accrual. When you're accrual, you recognize it when you earn it. So that's really what the difference is between the two. But timing is going to matter because the year that you recognize it in then leads to the year that you're going to pay taxes on it. Now, the majority of small business owners probably feel like the best thing to do, right, when you're staring down the barrel of tax season is to delay the collection of income, right? If you have outstanding invoices, maybe you don't collect them yet, maybe you wait for those to come in January unless you need the cash flow, right? Because that means that you're paying taxes on them next year. And increase your expenses this year. So maybe move forward some expenses that you know you're going to have next year into this year, or make some investments that you've been considering this year instead of next year. Those two things will have the impact of reducing your profit in the current year, which then reduces your taxes, right? So for a lot of people, that's kind of the strategy that they use. Now, this can be an okay strategy, but I want you to think about a few things when you are doing this, okay? I don't want you to get too short-term focused when you're making these decisions. And what I mean by that is, think about which year does it make sense? Which year are you expecting to be in a higher tax bracket, i.e. have a higher tax rate? So if this year was a huge year for you and it was unusually huge and you think next year it might normalize a little bit and go back down to what it usually is from a profit perspective, then you probably have a higher tax rate this year than you will next year, which means delaying income collection and moving up expenses is actually probably a pretty good strategy. That might make sense. Again, you don't want to spend money on things you don't actually need and won't turn into an investment in your business, won't turn into more money down the line, right? We're not looking for any and everything to spend money on. That's a bad strategy. But if it's something that you plan to use or is a good investment in general, and you're trying to, move some income out of this year, that might not be a bad idea. Now, where is this a bad idea? Well, like I said, timing matters, right? So this is a bad idea if you're in a situation where you're expecting significant growth next year, right? Maybe there are certain things happening that may allow you to reach new markets, or you're launching new things that you expect to do well. If you have that line of sight to say, actually, I think we might double next year in size and in profit. Well, if that's the case, might it not make sense to actually get that income in the current year and have more profit in the current year when you're at a lower tax bracket, and then keep those expenses for next year, right? Because that's one of the things, if we're thinking too short term, we might make those decisions that really only affect us in the short term, but we aren't thinking about paying less in the long term. And I would imagine that most of us, when we look at it, probably care more about paying the least amount in the long term. Long term being only a year or two, right? We're not talking like 20 years, but the next year or two versus just right now. I just would challenge you to think about, what do I expect for next year? If you expect it to be relatively the same as this year, right, then it probably does make sense to be looking for tax savings opportunities when you can. Now remember, you also have a lot of control over this timing, right? So we may not realize it, but when we invoice, when we collect those invoices, right? Sometimes we have invoices we haven't gone out and collected on if you are in a business like that. Sometimes we could be deciding if we're going to do a new promotion at the end of the year or the beginning of next year, right? We have a little bit of sway in how we decide to do that. And especially with expenses, we have a lot of control around expenses, meaning that we can decide if we pay something this month, if we pay it next month in a lot of instances. Not all instances, but in a lot of them. So my strategy number 2 still relates to timing, but it's a little bit more specific with regards to expenses. Okay, so if you do decide you're trying to save taxes in the current year, and therefore you want to have more expenses in the current year, again, like I said, don't just go spending on anything and everything. That's counterproductive. But one strategy I like to employ is thinking about, okay, what things am I using? What things have I been using? Maybe software programs, things like that I'm paying monthly for, that I could save if I did an annual plan. And I know it's something that I'm going to continue using, right? It's something that I use frequently in my business. Can I go ahead and pay for the annual plan and pay that year up front? So again, cash basis taxpayer, you can do that. Doesn't matter that you're using it next year and you're paying for next year, you are going to take that expense all in the year that money comes out. So that's one example of a place where you could do that. Similarly, you could look at buying assets or things like that. Again, be a little bit careful there. You do want to talk to an accountant, likely if you're going to be buying significant assets, because then you're getting into the realm of depreciation, and there are some specific rules around depreciation you want to be aware of before you buy any big assets, and you really want to make those decisions with the long term in mind, okay? Now, the third thing that you're going to want to make sure that you are looking at as a business owner, and honestly, this is one of the best and easiest ways to save on taxes without actually having to spend money, and that is contributing to a retirement account. Now, you're definitely going to want to work with a financial planner on this, because depending on the type of account you have, it's going to determine the tax impact of that. So your traditional IRAs or your traditional 401ks, right? Or maybe your SEP IRAs, things like that. Typically, you get that tax impact up front, meaning that you get tax savings on any amount that you contribute in that year up to a specific limit. That limit depends on the plan and oftentimes on your income, okay? Those are the ones that give you an immediate tax benefit. There are other plans that don't give you a tax benefit right away, but they give you a tax benefit on the earnings where you don't have to pay taxes. And those are generally going to be Roth accounts, like Roth IRAs, okay? And it can really depend which is best for you. It can depend on your goals. It can depend on your age, right? It can depend on how close to retirement you are, what the limits to those are. And oftentimes it makes sense for people to contribute to both if they can, okay? Roth limits tend to be a little bit lower, but there are ways that you can work with a financial planner to still be able to contribute. So that is something to talk about with your financial planner. But know that if you do decide to contribute to a qualified plan that is more of a traditional plan where you do not have to pay taxes in the current year, that's going to save you money now. So that's something to consider. And oftentimes when people come to me and tell me that they haven't planned for the taxes that they're going to have to pay and they want to figure out ways to reduce it, that's the number one thing. Max out those retirement plans. Why? Because you don't have to pay any taxes on that amount. If you put $10,000 into one of these retirement plans, assuming that that works within your limits and your income of the plan that you have, that's $10,000 of income you don't have to pay taxes on, but you still get to keep it, right? So we're not spending that money. We're not spending it to get a tax deduction. We're not doing anything crazy. We get to keep the money Now, we can't touch it for a little while, right? That's the drawback, but you get to keep the money and pay no taxes on it, which is fabulous. So that is something that I think we try to get a little bit too complicated in all these tax strategies, but for most individuals and small business owners, that's one of the best ways to save money on taxes is just by maxing out your retirement plans. Now, let's talk about timing here because it does matter based on the plan when you have to contribute by, but most plans you do have to have open by 12/31. So if you haven't done that, you want to quickly get that together if you're watching this in December and make sure you have a plan open if you don't have one already. But then you usually have a grace period of a little while into the next year to be able to make those contributions. And again, that's going to depend on the plan that you have. So make sure to check that. But the reason that they do that is because oftentimes, especially with something like a SEP IRA, the amount that you can contribute is based off of how much you made. Well, you don't know how much you made until you have the full year and you've been able to sit down and run your P&L and figure out what your profit is, because that's going to factor into how much you can contribute into your retirement account. So that's why they give a little bit of grace period for that, because it allows you that time to figure out what you're able to contribute. Now, let me tell y'all, we've only scratched the surface in this video about the things that you want to do as business owners leading into year end, okay? So there's more than this. There are more additional tips and things like that that you want to be thinking about as a business owner, both now prior to the end of the year, as well as after January 1st. What are the first things that you want to be doing to set yourself up for success? There are a lot of things regarding that as well, and that's why I have made a checklist. So I have a completely free checklist. Go download it, jamietrull.com/year end. Okay, jamietrull.com/year end. You're going to be able to grab my year end finance checklist. This is for your business finances to make sure you're not forgetting anything. It has some important deadlines and things like that that you need to remember as well, and some extra bonus tips that I did not include in this video. So make sure that you grab that checklist, and I will see you next time.